Everyone is waiting for lower interest rates. Everyone is waiting for that magical moment when the Fed cuts, mortgages drop, and life finally becomes affordable again. But what if lower rates don't save the middle class? What if lower rates trap the middle class? Because here's the question almost nobody is asking. The question is not only whether interest rates will fall. The real question, the dangerous question, is what happens after they fall. Who actually benefits when money becomes cheap again? Who pays the bill nobody talks about? And why do millions of Americans make more money than ever before, and still cannot afford a home, a car, or a calm night of sleep? In the last video we talked about the trigger, the stimulus, the headline that shocked the markets. Today we are not talking about the trigger, we are talking about the consequence. And the consequence is much bigger than the stimulus itself. Because if you understand what is coming, you can see it before it hits your wallet. If you don't, you will only notice when your paycheck stops working, and by then, it will already be too late. So before we go deeper, do me a small favor. If you want to keep seeing these breakdowns, hit that subscribe button right now. It is free, it takes 1 second, and it helps this channel reach more people who are tired of being kept in the dark about how money really works. Subscribe, and let's continue. Let's reframe this story. In the previous video, the stimulus was the headline, the trigger, the decision, the political move. In this video, the consequence is the headline. I am not going to repeat the full explanation from the last video. If you missed it, you can watch it after this one. What you need to know is simple. The stimulus is reaching the economy through 3 main channels. Channel 1. Lower mortgage rates, which change how much a home really costs every month. Channel 2. Refinancing, especially cash-out refinancing, which turns the value locked inside your home into spendable money. Channel 3. The government itself, which pays less interest on its enormous debt when rates fall. 3 channels, 1 stimulus. But each channel produces a different consequence, and not all consequences are good for you. Let's start with the one that hits closest to home. Literally. Consequence number 1. Housing does not become cheap. Competition increases. This is the trap almost nobody sees coming. When mortgage rates fall, the monthly payment on a home falls too. So people think, finally, homes are affordable again. Finally, I can buy. Finally, the market is on my side. But here's what really happens. Lower rates do not create more houses. Lower rates create more buyers. And when you have more buyers chasing the same limited supply of homes, prices do not stay still, prices go up. Bidding wars come back. Sellers raise their asking price because they know desperate buyers are entering the market again. Let me show you with a simple example. Imagine a house that costs $500,000. With a mortgage rate of 7% over 30 years, the monthly payment on the loan is roughly $3,300. Now imagine the rate drops to 5%. The monthly payment on that same $500,000 home falls to about $2,700. You just saved $600 a month. Sounds amazing, right? But here's what the market does. Suddenly, thousands of buyers who were sitting on the sidelines come back. They start competing, they start bidding. And that same house that was listed for $500,000 is now selling for $575,000. Or $600,000. At $600,000 and a 5% rate, the monthly payment is back to around $3,200. Almost exactly where you started. You did not get a cheaper home. You got the same expensive home with a different label on it, and it gets worse. Because while the mortgage payment may be similar, the property taxes are now higher because the home is worth more. The insurance is higher. The maintenance is higher. The HOA fees are higher. The middle class does not get relief. The middle class gets a new version of the same prison. This is why so many people are saying online, I make more money than ever, and I still cannot afford a home. It is not your imagination. It is the math of a system where lower rates plus limited supply equals higher prices, not cheaper homes. Consequence number 2. Refinancing becomes the new stimulus check. Now let's talk about the people who already own a home. When rates fall, millions of homeowners are going to do something very predictable. They will refinance. Some will refinance to lower their monthly payment. Others will do something more aggressive. They will do a cash-out refinance. A cash-out refinance is when you take a new mortgage that is bigger than your current mortgage, and you pocket the difference in cash. Suddenly you have $30,000, $50,000, $100,000 in your bank account. It feels like free money. It feels like winning. It feels like the system finally rewarded you. But here's the consequence. That money did not appear from nowhere. You did not earn it. You did not save it. You borrowed it from your own home, from your own future. You took the equity that you spent years building, and you converted it into new debt. And what happens with that money? Most of it gets spent. Vacations, cars, renovations, credit card payoffs that come back again. Consumption. That spending pushes up demand in the economy. Higher demand pushes up prices. Higher prices feed inflation. And inflation eats the value of every dollar in your pocket. So you end up with a cycle. Home equity becomes a cash-out refinance. The cash-out refinance becomes consumption. Consumption becomes inflation. Inflation becomes more personal debt. And the cycle gives you a false feeling of wealth that disappears the moment the music stops. Let me say this very clearly. This is not a stimulus check from the government. It is a stimulus check borrowed from your future self. And your future self does not get to vote on it. Consequence number 3. The government may be the biggest winner. Now we get to the part that almost nobody talks about on television. Why does the political system want lower rates so badly? The easy answer is, to help home buyers, to help families, to help the economy. But there is a deeper answer, a more uncomfortable answer. The government itself is the largest borrower in the history of the world. The United States carries a national debt measured in tens of trillions of dollars. And every single year the government has to pay interest on that debt. When rates are high, that interest bill is enormous. We are talking about more than $1 trillion a year just to pay interest. Not principal, just interest. That interest now competes with the budget for defense, with the budget for healthcare, with the budget for social programs, with the budget for everything. So what is the easiest way to shrink that interest bill without cutting a single program and without raising a single tax? Lower the interest rate. Watch the logic carefully. The government collects trillions in taxes. It spends more than it collects. It covers the difference by issuing new debt. The higher interest rates are, the more expensive it is to roll over that mountain of debt. Lower rates make the bill smaller. Lower rates rescue the government's balance sheet. But somebody has to pay the price for those low rates. And that somebody is the saver. The retiree. The conservative investor. The person who did everything right, who saved their money, who avoided risk, and who now watches their savings lose value every single year, while the government's debt gets cheaper to carry. So here's the dramatic question you should be asking yourself right now. What if the real stimulus was never for you? What if the real stimulus was for the balance sheet of the government? And here is something even more uncomfortable. Who actually receives those interest payments on government debt? It is not the average American. It is the largest banks. It is foreign governments. It is the wealthiest funds in the world. So when the government decides to make that interest cheaper, it is making a transfer of wealth that almost nobody understands. The system is not broken. The system is working exactly as it was designed. Consequence number 4. Financial repression. Let me introduce you to a phrase that will explain almost everything you feel about money in your life right now. Financial repression. It sounds technical. It sounds boring. But once you understand it, you will never look at the economy the same way again. Financial repression happens when the government or the central bank deliberately keeps interest rates below the rate of inflation. So if inflation is at 4%, but you can only earn 2% on your savings, you are losing 2% of your purchasing power every single year. Quietly, invisibly, automatically. That 2% does not disappear. It gets transferred. From the saver to the borrower. From the citizen to the government. From the careful to the indebted. This is why so many people online are saying that financial repression is legalized theft. Because that is exactly what it is. It is a transfer of wealth that nobody voted for, that nobody can opt out of, and that most people never even notice. Who loses in financial repression? Let me list them clearly. People holding too much cash in the bank, retirees who depend on fixed income, workers whose wages do not keep up with inflation, conservative savers who avoided the stock market because they wanted safety, people depending on positive real returns from bonds, CDs, and savings accounts. Every one of those groups is being slowly drained. Who tends to be better protected? People who own productive assets. People who bought real estate at reasonable prices before the wave hit. Owners of strong businesses that can raise prices when their costs go up. Holders of real assets like land, commodities, and infrastructure. People with income that adjusts upward with inflation. Now I have to stop here and be very honest with you. I am not telling you what to buy. I am not giving you financial advice. I am not your advisor. I am showing you the game being played on the field. What you do on that field is your decision. But here is the message that matters. The middle class is not being hurt by accident. The middle class is being hurt by design. Because financial repression only works if the middle class keeps their money in places that lose value silently. The moment people understand what is happening, the game gets harder for the people running it. That is why so many in the comments keep saying it. The middle class is being programmed to fail. Not because anyone is shouting it, but because the system rewards behaviors that quietly destroy your purchasing power, and punishes the behaviors that used to build it. Stop for 1 second. If this is making sense to you, if you are connecting dots that nobody explained to you in school, do me one small favor. Drop a comment below with the word repression. Just that one word. It tells me you are paying attention. It tells the algorithm to push this video to more people who need to see it. And it builds a community of people who refuse to be financially asleep. And while you are down there, hit the like button. Costs nothing, and it helps enormously. Now let's keep going. Because the next consequence is the one that could break the entire plan. Consequence number 5. The Fed may not be able to deliver what Trump wants. Here's something the headlines almost never explain correctly. The president does not control interest rates. The Fed chair does not control interest rates alone either. The Fed chair is one vote on a committee. The committee is called the FOMC, the Federal Open Market Committee. They meet, they debate, they vote. But even the FOMC does not have the final word on the rates that actually matter to your life. Because there are other voters in this room. Voters that nobody elected and that nobody can fire. The bond market votes. Inflation votes. The buyers of U.S. Treasury debt vote. Foreign central banks vote. Pension funds vote. Insurance companies vote. Every investor who decides to buy or sell a long-term treasury bond is casting a vote about the future of American money. So let me put this as clearly as I can. Trump can pressure the Fed. The Fed can cut short-term rates. But the bond market decides how expensive long-term money really is. And long-term money is what matters for your mortgage, for your car loan, for your business loan, for the cost of a 30-year fixed home. The 30-year mortgage rate is not tied directly to the Fed funds rate. It is tied to the 10-year Treasury yield, to inflation expectations, and to how much demand there is around the world for U.S. government debt. So imagine this scenario. The Fed cuts rates. The president celebrates. The headlines say victory. But the bond market is not convinced. Investors look at the inflation outlook. They look at the size of the deficit. They look at how many trillions of new debt the government needs to sell next year. And they say, we will buy that debt, but only if you pay us more. Long-term yields go up, not down. Mortgage rates stay stuck. The stimulus gets blocked at the door. This is what makes this moment so dangerous. Because the political system can pull the lever, but the lever is not connected to the engine the way most people think it is. And there is a phrase that keeps coming up in the comments that captures the fear perfectly. This feels like repeating the mistakes of 2008 and the pandemic. Because in 2008, cheap money inflated a housing bubble until it exploded. In the pandemic, cheap money plus huge stimulus created the worst inflation in 40 years. And now, here we are again, talking about cheap money and stimulus, while pretending the consequences will somehow be different this time. The consequences are never different. The timing is different. The trigger is different. But the math is always the same. The consequence map. 3 possible scenarios. So where does this all lead? Nobody knows the future with certainty. Anyone who tells you they do is either lying to you or selling you something. But we can map the most likely paths. We can look at the road ahead and identify the 3 scenarios that almost every serious economist is watching right now. Let me walk you through each one. In simple language, with real-life examples, so you can recognize the scenario the moment it starts unfolding around you. Scenario 1. The artificial soft landing. This is the scenario the political system is praying for. In this scenario, the Fed cuts rates. Mortgage rates ease down. The housing market wakes up. The stock market celebrates. Consumer confidence improves. Headlines talk about a soft landing, a rescue, a miracle. Underneath the surface, inflation refuses to die. It does not explode, but it does not disappear either. Groceries stay expensive. Insurance keeps rising. Rent keeps climbing. Energy bills do not drop. The economy looks fine on television, but when you walk into a supermarket, your cart costs 40% more than it did 5 years ago. When you renew your car insurance, the bill is higher. When you look at your bank account at the end of the month, the math is tighter than it should be. This is the scenario where the average person feels something is wrong, but cannot explain why. The headlines say everything is great. Your wallet says everything is harder. This is the scenario of slow erosion. You do not get crushed, you get drained. Scenario 2. Reinflation. This is the scenario that keeps every serious investor awake at night. In this scenario, the Fed cuts too early, or it cuts too aggressively, or it cuts under political pressure before inflation is truly defeated. What happens next is brutal in its simplicity. Cheap money returns to the economy. Consumers feel optimistic again. They start spending. Companies start raising prices because demand is back. Commodity prices wake up. Oil starts climbing. Food prices rise again. The dollar weakens because international investors see that the United States is choosing growth over discipline. And then, inflation comes back. Not the old inflation, a new wave. Sometimes worse than the first. This is what happened in the 1970s. The Fed cut rates too soon. Inflation came back stronger. They had to raise rates dramatically to kill it, which caused a deep recession. Millions lost their jobs. Mortgage rates went above 18%. Families were destroyed financially. Could it happen again? Nobody knows. But every honest economist will tell you the risk is real. In this scenario, the cost of living squeezes the middle class so hard that lower mortgage rates do not even matter anymore. Because if your groceries, your insurance, your gasoline, and your rent are all rising faster than your wages, what difference does a cheaper mortgage make if you cannot even reach the down payment? Wages are not keeping up with inflation. That is not an opinion. That is what millions of Americans are living right now. Scenario 3. The bond market revolt. This is the scenario almost nobody is talking about, and it might be the most important one. In this scenario, the Fed cuts short-term rates exactly as planned. The political system cheers. The headlines deliver victory. But the bond market refuses to play along. Long-term Treasury yields do not fall. They actually rise. Why? Because investors look at the size of the federal deficit, the mountain of new debt the government needs to sell, the political pressure pushing the central bank, and the inflation that has not been fully defeated. And they say, we are not going to lend you money cheaply anymore. If you want our money, you are going to pay a premium. This is called a steepening yield curve. It means short-term rates fall, but long-term rates rise. And when long-term rates rise, mortgage rates rise with them. Car loans get more expensive. Business loans get more expensive. The cost of borrowing stays painful. In this scenario, the stimulus fails to reach the people it was supposed to help. The Fed loses control of the long end of the curve. And suddenly, everyone realizes that the bond market has more power than the president and the Fed combined. If rates fall, who keeps buying government debt? That question, posted in 1,000 comment sections across the internet, may turn out to be the most important question of this entire decade. Because if the answer is fewer people at higher costs, then the entire game changes. Not just for politicians, for homeowners, for renters, for savers, for everyone. The practical section: what to watch with your own eyes. Now I want to give you something useful, something you can actually do. You do not need to be an economist to read what is happening. You just need to know which signals to follow. Because the headlines are noise, the data is signal. Here are the indicators I want you to start watching with your own eyes. Not because anyone tells you what they mean, but because you can see them changing in real time. The 30-year mortgage rate. This is the heartbeat of the housing market. If it falls and stays low, expect more buyers, more competition, and rising home prices. If it stays stuck, the stimulus is not reaching where it was supposed to reach. Monthly inflation, the official number. Watch the trend. 1 bad month is noise. 3 bad months in a row is a signal. Energy and oil prices. When energy gets more expensive, almost everything else gets more expensive. Trucks burn diesel. Factories burn fuel. Food travels long distances. Energy is the silent multiplier of inflation. The 10-year and the 30-year Treasury yields. These tell you what the bond market really thinks about the future. If the Fed is cutting and these yields are rising, that is a warning sign nobody on television will explain to you clearly. Median home prices. Watch them in your own region, not just national numbers. Your zip code is the only zip code that matters for your life. Refinance applications. When this number explodes, it tells you that homeowners are converting equity into cash. That cash will flow into the economy and add pressure on prices. Total credit growth. When credit card debt, auto loans, and personal loans grow too fast, you are looking at an economy running on borrowed time. Gold. Gold is the oldest form of money. When gold rises strongly, while interest rates are still high, the market is telling you something important about confidence in paper money. The US dollar index. Watch how strong or weak the dollar is against other major currencies. A weakening dollar means imported goods cost more. A strengthening dollar means American exports become more expensive abroad. Unemployment. Not just the headline number. Watch the trend. Watch how long people are unemployed. Watch the quality of the new jobs being created. Real wages. This is the most personal one. Are wages actually rising faster than inflation, or are they falling behind? This is the difference between progress and the illusion of progress. You do not have to track all of these every day, but check them every couple of weeks. Build a habit. Because the people who watch these numbers are the people who do not get surprised. And the people who do not watch them are the people who only find out something changed when their bills no longer match their income. Before we close, I want to say something important. Something I do not want you to miss. This is not a story about one president. This is not a story about one party. This is not a story about Trump alone, or Biden alone, or any single politician. The temptation to spend more than the country collects exists under both parties. The temptation to push the cost of today into the future exists under both parties. The temptation to pressure the central bank into making money cheaper exists under both parties. The temptation to use inflation as a quiet tax on the middle class exists under both parties. If you make this story about red versus blue, you will miss the real game. The real game is about debt. The real game is about the value of money. The real game is about who pays the bill when the bill finally arrives. Somebody in the comments said it perfectly. The economy is not powered by money anymore. It is powered by debt. That is the most accurate sentence I have read about the modern economy in a long time. Because once you see that, you understand why every solution looks like another loan. Why every stimulus looks like another future tax. Why every rescue looks like another transfer of wealth from the careful to the reckless. The system needs more debt to survive. And the people who do not understand that system are the ones who pay for it. So let me bring this home. The consequence of the stimulus is not that everyone gets richer. The consequence is that the rules of money change again. And most people only notice after their paycheck stops working. Lower rates may not save the middle class. Lower rates may trap the middle class. In housing prices that rise faster than wages. In savings that lose value silently. In a cost of living that climbs while the headlines say everything is fine. In a financial system where the people who do everything right end up falling behind. Trump triggered the stimulus. Now comes the consequence. And the question is not whether you like it. The question is whether you understand it before it reaches your wallet. Because the people who understand the rules of the game can adjust. The people who do not understand the rules become the fuel that keeps the game running. You have a choice. You can keep watching the headlines. Or you can watch the indicators we just talked about. You can keep listening to the political noise. Or you can read what the bond market, the dollar, and the inflation numbers are quietly telling you. I am not telling you to be afraid. I am telling you to be awake. This is not financial advice. I am not your advisor. I do not know your personal situation, your goals, your debts, or your savings. What I am giving you is a map. What you do with that map is your decision and your responsibility. So now I want to hear from you. Drop a comment below. Tell me which of the three scenarios you think is the most likely. Soft landing, reinflation, or bond market revolt. I read the comments, and the discussions in this community are some of the smartest I have seen anywhere on the internet. If this video helped you see something you had not seen before, hit that like button right now. It is the single biggest favor you can do for this channel. It costs you nothing, and it helps this message reach more people who are tired of being financially asleep. There is one more video appearing on your screen right now. It is the perfect next step in this story. Click it, watch it, because the picture only becomes complete when you connect this consequence to what comes next. Stay sharp, stay awake, and I will see you in the next one.